Hey, welcome back to another video here at FiscalVoyage. I'm Felix, and today's video we're going to talk about a particular stock that's jumped almost 10-15% in the past week, and because of the recent earning release. And this stock in particular I covered in a previous video a few months ago, and we're going to talk about that video. We're going to look at the earnings release, and we're going to look at fast graph to see where it is and how it's projected to do going forward. And if you're new to the channel, make sure to hit that subscribe button. And if you'd like to make money, hit that like button to help the channel grow and for the YouTube algorithm. And let's get started with the stock. All right, so the stock I'm talking about is Anthem Inc., ticker symbol ANTM. You can see here on June 18, I made a video on Anthem Inc. I put the title as 20% annual return for the next 3 years. Take a look at this stock. And at that time, I had a fair price of $303. It was 14% undervalued, and at that day, it was going for $265. And if we look at today's market, June 16, I think it was June 16 here, or 18. You can see here the stock is up 18%. It had a big week this week. You can see overall since that video is up 18%, but earlier this week the stock jumped over 20% in a few days because they had a really good quarter. So we're going to talk about the quarter, and then we're going to go into fast graph and look at potential long-term investments. So you can see here in Seeking Alpha, Anthem EPS beats by 2 cents, beats on revenue. So non-GAAP earnings came in at $4.20. It beats by 2 cents, and GAAP earnings came in at 87 cents, which was down $2.96. These are from estimates expectation. The $2.96 is from like one-off cost. Revenue was 15.9% higher year over year. It beat estimates by $770 million. So it was great estimates there. So let's look at Anthem third quarter results here in the press release. So you can see here earnings per share, GAAP net income was 87 cents per share in the third quarter, including net negative adjustment items of $3.33 per share. This is what I was talking about. They had like those one-time costs. Adjusted net income was $4.20 per share. And this is what's also driving the price higher for Anthem. GAAP net income is expected to be greater than $17.87 per share, including approximately $4.43 per share of net unfavorable items. So that's good there. Excluding these items, adjusted net income is expected to be greater than $22.30 per share. And this is higher than 2019, $19 or so that they've made in 2019. So there's going to be positive year-over-year growth of about 14 to 15%. And if we look at the income statements, you can see here total revenue came in at $31 billion and versus $26 billion in 2019 for the third quarter. This is a growth rate of 16.8%, which is a good growth rate considering all the things going on this year. And the third quarter net income, you can see here that they lost 81% at $222 million. Versus $1.1 billion they made last year for the third quarter. Again, this is because of these one-time expense here. You can see here cost of products sold, an increase of almost 200%. Selling, general, and administrative expenses increased by 55%. So a lot of these are like one-time cost items. But if we look at the net income statement for the 9 months, you can see here for the beginning of the year to the end of September 30, they made $90 billion versus $76 billion for the 9 months in 2019. This is up 17.2%. And then net income is up 3.8%, giving the company good diluted earnings per share of $15.75 versus $14.83, which is an increase of 6.2%. So this is a lot of the reasons why the company, price jumped tremendously after earnings release. And we look at the balance sheet, total assets did increase year over year, as well as liability increased year over year. Most of the liability came from medical claims payable, as well as accounts payable and accrued expenses, and as well as other current liabilities. So we look at the fast graph for Anthem Inc. You can see here the company has been doing very well. If we just look at the actual company, they've been growing basically every year. The only year they didn't grow was in 2008 when they had a negative 1% earnings growth from $5.55 in 2007 to $5.48 in 2008. But since then, they've been growing very nicely, double-digit growth rates in some years. It went as low as 4% in 2014. But this last year, 2018, they grew at 32%, 2019, 22%, and this year they're expected to grow 15%, 13% in 2021, and 12% in 2022. And you can see this tremendous growth here because of that. So that's very impressive. But if we add the price here, the market tends to value this company in the long term more or less at 13.7 PE ratio or 14 PE. And if we shorten this period to a 5-year period, you can see here that the company looks to be slightly undervalued to fairly valued based on the normal multiple. But even at today's price, this was yesterday's price, and the stock is actually down slightly today. But based on yesterday's price, you can see you still have a nice total annual rate of return, about 16.4%. It's not as great as it was before. I think before it was about 20% growth rate because it was such a much better price. You can see here how price affects your total return based on valuation. This is why I had that title, 20+% return in the next 3 years. Now, if you were to purchase it today, it looks like about 16% return for the next few years. Still very good return. The company is very solid. You can see here A credit rating, so it's investment grade. Very strong, low long-term debt to cap ratio, outstanding. The earnings yield looks good at 6.8. The dividend is the only thing that's low. It's actually, I think it's lower than the S&P 500 currently, but at 1.19 is decent. And they've been growing dividends. I will sure extend this. They've been growing dividends for from 2012. So you can see here they've been having a nice dividend growth rate. They did slow down in 2016. Last year with a decent growth at 6.7. But overall, you can see here the company total annual rate of return since the beginning of 20 years has been beating the S&P 500 at 15.8% versus the S&P 500 at 7.14%. So overall, solid company. I don't think it's as attractive as it was when I made that original video. I think it's still a decent buy, but I personally wouldn't buy it at today's price. Maybe wait for a pullback. I would like to see it around a PE around 13, maybe 12 or something like that. It's a decent buy, but overall solid company. And you can still make a decent rate of return, about 15% for the next few years. Overall solid company. And I hope you guys took advantage when I made that video of this company, Anthem. So there you have it. Anthem did really good. I called it. The company, if we look back at that previous video, the company fundamentals was outstanding. High credit rating, low dividend yield, or low dividend payout ratio, and high earnings growth the past few years and going forward as well. So that's what drove the stock price to jump as we just saw. So thank you for watching. I hope you guys enjoyed the video. Again, if you're new to the channel, make sure to hit that subscribe button. And if you like to make money, hit that like button. And I'll see you guys in the next one.